Hi everyone and welcome. It's Steve Johnson here, Chief Investment Officer at Forager Funds. Hope you've had a wonderful Christmas and New Year, and we've got lots of registrations for today's webinar, which suggests people are starting to turn their minds to their investment portfolios, which is great. I'm joined today by Bella Foley, filling in for our International Fund portfolio managers, Gareth and Harvey. Bella's been working very hard on the International Fund for the past couple of years. Hi, Bella.
Hello, Steve. How are you?
Great to have you on board, and I'm sure everyone will enjoy getting to meet you. Before we kick things off, today's webinar is general advice only. We do not take into account your personal circumstances, and you should seek professional advice where necessary. The usual format for our webinars, I'll give a brief introduction and overview, and Bella's going to cover off on the international side of things, and then I'll come back and talk about the Aussie fund at the end of the year. You should all have your quarterly reports in your email boxes this morning. Some really nice content in there, and hopefully a bit of time for you all to read that over the next few days. It's one of the longer ones we've done in a while. Lots of new stock ideas, and yeah, my cover introduction letter is certainly getting a few responses already as well. It's been a good year of returns for broader equity markets and both of the Forager funds as well, with returns in excess of 20% in that 2024 calendar year. And most importantly, on the right-hand side of these tables, long-term returns here looking quite good as well, and particularly on the Aussie side of things, some really significant improvement there over the past few years, which we've been talking a lot about, but nice to see it turning up in the numbers as well. I talked about the active funds management business in my cover letter. A couple of listed active fund managers here in Australia have been having a pretty torrid time. This is the share price chart for Magellan Financial and Platinum Asset Management. They're both down 80% over the past 5 years, and it brings me no joy whatsoever. I think the founders of both of these companies were very generous with their time when I was working at Intelligent Investor, and there's some philosophical alignment there between what they do and what we do here at Forager as well. And yeah, this share price move, it's probably a bit of a shock to anyone that's been invested in the listed companies. If you looked at them 5 years ago, they were highly profitable businesses with net cash on the balance sheet. To see the share price of companies like these fall 80% is something of a shock. And I've talked in my cover letter about three, I think, important lessons from this. One is funds management companies are risky businesses. Yes, the economics are fantastic on the way up when the inflows are coming in and the business is growing. They're generally quite fixed cost bases, and they get very, very, very profitable as they grow. At the time that it listed on the stock market in 2007, Platinum's profit margins were 90%. So it was keeping 90% of every dollar in revenue as profit. It only had 25 staff at that point in time, and just showed how profitable they can be. The problem is when the tide turns, the economics work in reverse. And my experience has been in these types of companies, when it does turn, it is very, very difficult to reverse. You can see the net inflows and outflows here for Platinum over the past 14 years. And it's been a pretty consistent long period of money flowing out. The first thing that happens is institutional clients take their money pretty quickly. There's usually someone at the other end of that transaction that's looking for someone else to blame. So the money goes out the door quite quickly. Retail investors can be slower, but once it does go, I think the trend's very, very difficult to reverse. And you can see here that if anything, it's been accelerating at Platinum in recent years. One thing we've even noticed in our own business, after you go through a period of difficult performance, when that performance recovers, a lot of people inside funds management companies are sitting there thinking, well, the inflows are going to turn quite quickly. And what you get first is a portion of your investor base that has just been waiting to get their money back before they send in the redemption check. And it's sometimes a period of elevated outflows even after the performance starts to recover. So that whole dynamic, it is actually a riskier business, I think, than most people think. And it should be, you should distinguish between these single philosophy type funds management companies and a platform type business, like a Pinnacle, for example, that has a lot of different fund managers in the stable. these ones are particularly risky. I think for investors in funds of both of these companies, I think there's a couple of important lessons. And again, there's no joy in all of this for me. I've actually recommended a lot of people, particularly with Platinum, invest in the products over the years. So the lessons are for me as much as for anyone else. But size really does kill in the funds management business. Platinum had about $2 billion of FUM back in the period where its performance record was outstanding in the early 2000s. By the time it listed, it had $6 billion of FUM. A decade later, it had more than $20 billion of funds under management. You know, we've talked quite publicly about our own challenges growing from 200 million of FUM from 20 million of FUM to 200 million of FUM. $20 billion, you are in a stratosphere where you are restricted to a fairly small number of very well researched, well picked over companies, and it makes life difficult. And then the second thing I'd say is changes in key personnel, and it doesn't always translate to a change in philosophy or strategy, but it can, and that can be a risk. And I think in the case of something like a Platinum, it can also lead to a business being slow to evolve its investment strategy and slow to adapt to the markets, and it's harder. That team was more than 100 people recently from the 25 that it started with, and I think when you lose that key person, sometimes the process and the philosophy can be more static than it needs to be. So look out for them getting too big, and look out for changes in key personnel. And then I wrote more about this than anything else, but I think there's some really important lessons for the active funds management industry in general. That is us. There is a lot of money that is shifting from active to passive. It's something like $3 trillion in the US over the past decade. And there's a lot of active fund managers that think it's causing bubbles and that it's all going to reverse at some point in time. I think overall it is a net good for the world. People are getting investment products at a much, much lower cost than they were, and they're delivering results that are quite good. And the message for those of us that want to thrive in active funds management is we need to focus on the areas where we can add value. For me, I think that's two things. One, the smaller end of the market, passive investing works well where the market is most efficient. You can see in this table that here in Australia, it's not just us doing well at the smaller end of the market. If you get on Morningstar and look at the category of small and mid-cap funds, on average, small and mid-cap fund managers are pretty significantly outperforming the small cap index here in Australia. It shows you that there is just more inefficiency at that end of the market. And if we want to continue to succeed, we need to be willing to stay small and continue to be able to invest in those smaller companies. And then I think the other thing is this index and ETF investing, it is very, very pro-cyclical. Funds management has always been pro-cyclical. There were always fund managers willing to launch new funds for whatever the latest fad was, but I think that has been amplified by the speed and accessibility of these new products. I highlighted a crypto-related ETF that was listed at the peak of crypto mania back in 2021 that subsequently lost 80% of its value. I think these waves of money in and waves of money out can create really good opportunities for the active manager who's willing to get on the other side of some of that momentum and allocate their clients' funds to attractively priced sectors at the right point in time. So there's still plenty for us to be doing, but this trend is not going away. With that, I'll bring you in here, Bella, and we'll move on to the International Fund. Why don't you kick things off with a bit of discussion about the returns in 2024?
Thanks, Steve. Now, as Steve said at the beginning, it has been a good year of absolute returns for the fund. You can see it there in the 1-year number. The fund did just over 21%. There's a couple things I want to mention here is firstly, currency had a big impact on that. The weak Australian dollar was a big tailwind for both the fund and the index. I mean, it just reached a 2-year low, so currency actually contributed about 10% of that performance. The second big theme, we've talked about it a lot, is the continued outperformance of large cap stocks. You can see it there in the MSCI All World Index return for the year. It did 28%. And then down the bottom, we've also highlighted the small cap index, which did almost 10% below that. So that outperformance, it continues to be a headwind to the fund. And I mean, you've got the S&P 500, the top 7 stocks make up 30% of that index now, Steve, and it's something we've talked a lot about recently.
Yeah, absolutely. And look, there were some encouraging, I think, signs just throughout the year. The first half of the year, small cap stocks started to perform quite well, and we really saw a reversion in the last 3 months back to mega tech stocks, and even I think just US markets versus the rest of the world have performed very, very strongly. You can see on this chart here, this is 2 decades of returns from the MSCI World Index, and it's split into US versus MSCI World. If you take the US out of it, is the black line at the bottom. And for the first decade, they were close to each other in terms of returns. The gap has grown over the past decade, and it's really accelerated in the past 6 months. And Harvey and I recorded a podcast on this at the start of 2024, talking about why we like investing in the US and some of the dynamics at play there that are very constructive to long-term returns in terms of the management of companies, the growth of the economy there relative to other parts of the world, and reasons why we had and still have the majority of our portfolio invested in that part of the world. But that American exceptionalism argument has become a theme of its own. You're seeing all of the ETF flows pretty much exclusively go into those markets, and it's creating some valuation differentials that I think are quite dangerous. And I've said to the team here, our job is to keep delivering double-digit returns to our clients over time. And as long as we're doing that, I'm going to be happy. If this thematic of the large US tech companies continuing to trounce everything else continues in 2025 and we underperform it, I'm perfectly happy for that to be the case, as long as those underlying stocks we own are delivering the returns that we want them to deliver. Bella, this it is actually creating new opportunities, and there's plenty of stuff for us to be doing in the portfolio because it's so concentrated on a small number of stocks in terms of performance. Why don't you talk us through a couple of the new ideas that we've put in over the past 6 months, starting with Wise PLC?
Yeah, so Wise is one that we have followed since its IPO back in 2021. And we started talking a lot more about this company in the office about a year ago when the international fund team started actually all using the app and card for international travels. I think I've now used the card on at least 5 different trips. And what is Wise? Well, it's a cross-border payments company, and it's always had a mantra of being the cheapest, fastest, and simplest cross-border money transfer company. And they're really winning customers. They've now grown to a customer base of over 12 million users, and they're moving £30 billion every quarter across the platforms. And one of the main features of this app is just how user-friendly the app is, and I can vouch for that myself, and I think other users do as well. I mean, 70% of their growth is coming from word of mouth referrals, and I know that's definitely the case around the Forager office.
Yeah, and I think that usability is something that you don't notice until it's not there. So everyone thinks it's easy because things work. And when you use something that's not as usable, that's when you really notice how good these things are. I've actually just flying out on a little holiday myself tonight, and I just was looking at a hotel in Vienna, and I went to the hotel's website and it said you can book directly through us and save 20%. And I'd been looking at it on booking.com. So for 20%, it's worth me putting in the effort. It honestly took me 15 minutes to get through the whole booking process, and we don't accept they wouldn't accept the Wise card. We don't accept this sort of card, and it was just difficult, and it didn't work, and I had to do it twice, and I ended up going through with it. But I thought, you know what, this would have taken me 30 seconds on booking.com, and it's just so easy and user friendly. And I think these products that work well like that, I went to Wise for cost. I went there because you can set up bank accounts in foreign currencies very easily. For me, that helps family overseas just transfer money to us, but you stay with it because of the usability. And what is the average take here, the average cost for users?
Yeah, it's down to almost 5% or so.
5 or half?
Half, sorry.
half 50 basis points, so half
Yeah,
of 8%. You're down to relative to when the banks were charging us 4 and 5% on all these overseas transactions on our credit cards. You're down to very low cost. So I don't think it's any more someone comes and says, well, I'll give it to you for 0.45%. The usability to me is more important to that now. And I think that will create a stickier customer base.
definitely. And they're not just winning on the individual side, they've built out an infrastructure. I mean, this company's been around since 2011, and it's just becoming more efficient. And they actually are now partnering with other banks as well. You've got leading names like Nubank, Standard Chartered, and in the last month, they also signed on Morgan Stanley. And we do think that this part of the business actually becomes a bigger piece of the pie in the future. And the fact that all these financial institutions on the platform side are choosing to partner with Wise instead of compete with them, we think that's really telling about the success of this business.
It's a great product, great platform. What about the economics of this company?
Yeah, so Wise is nicely profitable, and it's a bit of a unusual case because you actually have management saying that the company is currently too profitable. They're currently doing around 22% pre-tax profit margins and have targets of 13 to 16%. So whilst it is quite unusual to have a management team come out and say they want to be less profitable, it's really being driven by a flywheel effect. If you lower your exchange fees and pass those savings back to customers, you're just going to end up attracting more customers, and then those costs just get spread over a larger base.
Yeah, I really, of all the forms of competitive advantage, I think this efficiency flywheel is probably the most difficult for someone to come along and disrupt. Yeah, we've seen it at Costco in the US. I think you see it with JB Hi-Fi here in Australia. Their cost of doing business is very, very low. That allows them to charge customers lower prices. If you look at their gross margin, it's lower than most of the competition. Lower prices bring more business. That gives you more leverage to negotiate better deals, and you get lower prices again. And you just keep doing that. It is very, very, very hard for someone to come along and disrupt that, because the bigger you get, the more advantage you have over the competition.
Yeah, definitely. And I mean, management, they've gone from talking about moving billions to moving trillions. And we do believe them when they say it. I mean, you've still got very low market penetration here. On the individual side, they're only moving about 5% of all money that gets moved cross border. And on the business side, it's as low as 1%. So definitely excited about the prospects of this business.
Yeah, you can see on the chart there, we managed to get the timing on this one almost perfect, which is a bit of a rarity for us, but it's been a really strong recovery over the past few months. So we do love this business. We think it's got a really nice long runway ahead of it. There is more expectation in today's price than there was in the price even back in September. Moving on, Bella, this is interestingly another company where people might not know the company name, but the product might be quite familiar to quite a few people watching the webinar.
Yeah, so unlike being able to say that I've been a fan of the Wise card for a long time, this one is a little bit new to me and it is slowly growing on me. So for those not familiar with the TKO Group name, you might recognize World Wrestling Entertainment or Ultimate Fighting Championship, or the UFC as it's known. And TKO Group, it was formed through the merger of these two companies back in September of 2023. And whilst me, you might not jump at the idea of watching scripted fighting or mixed martial arts. They do have a really large and growing fan base. The combined entity, it reaches over 1 billion fans in 200 countries. And surprising to me, 35% of the wrestling side's audience is actually women. So I obviously have to step up and start watching a few more events myself. But the reason we really like this business is that sports franchises can be really, really great companies. And I know the fund historically has also owned a few different names in the space, Steve.
Yeah, we owned Madison Square Garden a few years ago in the International Fund, which owns the New York Knicks basketball team and the New York Rangers ice hockey team. The attention that you talk about is growing, and it's a great asset class. And some of these thematics we've talked about a lot with our Catapult investment here in Australia as well.
Yeah, I mean, just that whole live sports and sports franchise space, they're really valuable because they can capture audience attention better than other media content can. And it's not just valuable for advertisers, but also streaming giants are now starting to pay attention to these names. You recently saw Netflix do a $5 billion 10-year deal for the WWE to be streamed on their platform. It actually went live this week. I'm not sure if anyone would have tuned into the debut event on Monday night, but it's actually topped the US top Netflix charts after that event. And I think I even have to start watching a few more now that it's so accessible on Netflix, which is the whole premise of that story, is that you're going to reach more eyeballs globally now that it's so accessible. And I mean, the price tags now being paid, they're at significant premiums to all the prior deals done. There's more bidders in a market and only limited rights deals coming up for renewal. One that is coming up for renewal, though, is the UFC at the end of the year. And we think that this asset is actually the more valuable one in the business, and think that the price paid when it comes around for renewal after the deal expires with ESPN should be a positive one. And the long-term story here is that if you can secure these long-term rights deals, that's a really nice recurring revenue stream. And then you've also got booster revenue coming from your sponsorships, your merchandise, and your site fees. So that's definitely one that we really like.
Like Crocs, I'll let you do the consumption on this one, Bella. But the share price chart there's been pretty volatile, and there are some concerns here. The structure itself is a bit complicated, and maybe some governance concerns as well.
Yeah, you can see it there in October. What happened was they announced the acquisition of a few new assets. These included professional bull riding and On Location, a few others, which wasn't super well received at first by the market, just because it makes the story a little bit less clean than having the two well-known assets. So there is just a bit of added complexity there from a governance structure. At the same time, though, they did announce a $2 billion share buyback and also the initiation of quarterly dividends. So those were all on the positive side. And you can see that after a week or two, I think the market came to realize that, and they've taken it in a positive way. So that share price is back up and above where it was before the dip.
And elsewhere in the portfolio?
Yeah, so just a couple of updates that we wanted to mention, a few exits. These include Norbit. So Norbit is one we've held for many years in the fund. We acquired the position back in the IPO in 2019, and this is a Norwegian manufacturer of high-tech products, mostly in maritime logistics and tolling. And I think the key lesson for this one was that it required patience. You can see the share price move sideways for almost 3 years, and then we made most of our money in the last two, and it ended up being a fivefold return. But that one we exited in December, and this is one definitely that Gareth has talked a lot about wanting to own in the future, though. So if the share price does pull back, I think you should expect to see it back in the portfolio, although management keep executing and doing a good job for now. So that one is out.
And the Zeta share price, a bit of a similar story by the looks of it, although even more rapid appreciation.
Yeah, definitely. I think this is a name that some of our investors will be familiar with. We've written a lot about this one in our reports. It was our top performer in 2024. The share price rallied 230%. And by October, we realized, just valuation wise, that it was time to move on from that position and reallocate the capital elsewhere. But the share price has since pulled back a little bit. So again, the business is performing well. The growth there is really nice. So it could end up back in the portfolio at the right price.
And not so good at so good.
Yeah, unfortunately, this was also an exit during the quarter, but for the wrong reasons. This is a freeze-dried candy company in the US. It was actually unnamed Stock A in the performance report for any of you that might have read about it. The reason it even made it into the performance report in the first place is it reported a really strong second quarter, and the share price was up enough to make it to that top list. But unfortunately, after a pretty shocking third quarter result, we decided it was time to abandon that thesis and cut the stock and move on. And it was always a small position due to the risk, but yeah, that was definitely on the disappointing side.
Yeah, I think positively there, moving on and moving on quickly from things that are not working is something we've talked a lot about over the past few years. And on the flip side, upsizing things that are going well has been a key behind some of our good results recently. So process at play there, and as you said, it was risky right from the start and a small weighting as a result, but has caused some noise in performance through the up and then the down. Thanks for that, Bella. We'll move on to the Australian Shares Fund now, where we had a really strong end to the year in what was a weaker market here in Australia. The fund was up almost 12% for the last quarter of the year and 27% for the year, which, as you can see, there's well ahead of both the All Ordinaries Index and the Small Ordinaries Index, which had another year of underperformance. You can see in our numbers, and I touched earlier, it's not just us. There are smaller companies doing really well here in the Aussie market, and we've owned enough of them for the fund's performance to be quite good. And again, as I said at the start, 5, 10 since inception numbers there looking much better than they were a couple of years ago. I think as a reflection, I've been talking with some confidence, particularly over the past 18 months, but team and process and portfolio in a really good place here.
Steve, just quickly before you move on, you spoke about underperforming in the International Fund if things keep going the way they are. They clearly aren't going that way in the Aussie Fund. Just quickly, what's the difference between the two funds?
Well, look, the biggest difference is the performance of the two indexes and particularly that US component of what's happening globally. I said that earlier in terms of happiness with underperformance. It is all contingent on if this trend continues to play out. And that Magnificent Seven continues to perform so well. You look at the Aussie index, it's up 10 over the past year versus up close to 30 in the US. And the Magnificent Seven is only a Magnificent One of CBA here. So the environment, I think, has been much better for us to outperform. And like I said, I'm still really optimistic about good, healthy returns from that international portfolio as I am from the Aussie portfolio. It's just that those index dynamics that are at play are quite different. The biggest contributor to returns here in the back half of the year is Catapult. I said earlier about this getting rid of stocks where the thesis is not playing out, and this is a company where we've really upsized our investment here as the thesis has played out. It's a business that I have really appreciated the product for quite a long time. I run very regularly outside the Sydney Football Stadium and cricket ground here in Sydney, and all of the teams train in training facilities on the outside, and I just see Catapult equipment around every single ground and every single team. And you've seen it growing from men's to juniors to women's sport increasingly now. So the product has been sort of in my face for a very long period of time.
And I also have my first sort of exposure to it. Steve and I were both out at the cricket over the last week and a half, and he pointed out Jasprit Bumrah wearing the gear, and it seems that there's a lot more attention on that business now. So, Steve, how's it all going?
Yeah, well, I think I've been a appreciator of the product, but the stock has been a different story for quite some time. It's good to see you enjoy the cricket, Belly. You told me earlier you were going to do a Sam Constas type debut for us here today, and it's going very well so far. So good to see. Yeah, the stock has had a very rough time after an IPO that went very well. It got up to almost $4 a share. We had been accumulating this stock at less than $1 prior to this share price chart that you can see here. So the product has been growing, and it's been growing for almost 20 years. The business was founded back in the early 2000s. Some of the things that I like about it had been very clear, but it had not been able to translate that into profitability. And what you've seen here in the past few years is a US management team. I touched earlier about how they have a bit of a different focus on creating shareholder wealth, but that new management team came in a few years ago and said, look, this is how it's going to work. We're going to keep growing this business at 20% per year, but what you are going to see is that 50% of that incremental revenue, so the growth in revenue that we get, you're going to see it drop through to profitability over time. They've done that now for a number of results in a row. People are starting to believe the story, and you can see on the chart here what's happened in terms of the share price. I'm really confident still in the long-term returns from this business. I still don't think it's a widely owned stock. It will go into indices if it keeps growing and the liquidity keeps improving, and we'll see some of that passive buying. And I think more importantly, the revenue line here keeps growing at 20% per annum, I think, for longer than most people think at the moment. And based on where I think it gets to in terms of mature profitability, it should be trading at least the same revenue of that multiple that it's trading at today. So I think you're going to get revenue growth and share price growth here, and there's a lot of that to come. So it's a company that we want to keep a big weighting here while ever that valuation remains sensible. And we've actually taken a little bit of money off the table recently. It's a 10% weighting in the portfolio. It would have been a bit higher if we'd done nothing, but that 10% weighting is sort of where we want to keep it for the foreseeable future. That stock, in terms of investment life cycle with us, is, I think, a thesis that really is proving up. This one is at much earlier stages. It's a new investment for the portfolio. And when Alex Shevelev came to me with EML back in April of this year, I think I, like a lot of other market participants, had a perception of the business due to its history that was very, very negative. This was a darling stock for a long time here on the ASX. I think the share price was in excess of $4 at one point in time. They used all of that excitement to go and do a couple of very expensive, very stupid acquisitions overseas. And from my perspective, quite predictably, they blew up. They wrote off some $300 million of $350 million of investments about 18 months ago. Alex's argument was, look, that is the perception of the business, but there has been a big cleanup job go on here, and the core business is a good business. And he has convinced me of that, and I think there's really good evidence for it. So EML Payments provides cards and payments infrastructure to companies and governments that want to control how the money gets spent. So we own quite a few payments companies, as people have seen in the portfolio. This one is quite niche because of that aspect of it. So where does it get used? It gets used for gift cards is a good example. Salary packaging. So when people salary package a car, and the fuel and the servicing and the insurance on that car, you use your fleet card to pay for it, and that all gets transacted that way. Governments use it for some welfare payments, for immigration payments, helping people set up in countries. So there's a wide range of uses, but it is all where the company or the company at the other end of it wants some control over how that money gets spent. It has actually been a growing business, and even despite all of the governance challenges over the past few years, that core business has kept growing. So we had a starter position in the stock here. You can see on the share price chart, it had a very, very good November. Share price was up a long way. That was a new CEO that had been appointed in June, came out with the AGM, put a new strategy in front of investors, laid out a case for this company making 13 cents of earnings per share in 2027, which is not that far away, and that share price is 65 cents. If it was doing that and growing, it would be very cheap. Everyone started to get behind the story, and there was I think some evidence starting to come in for the thesis here. Then on the 23rd of December, the company announced that they fired their CEO and the chairman was taking over as CEO. So it is quite clear that the governance issues are not behind this company yet. And I actually think they had just started the rebuilding confidence phase, and this is a pretty significant setback to it. So I think we'll still continue to see the business grow and become more profitable here, but in terms of market faith and attention, it might take a bit more time yet. Other news across the portfolio. November's almost a quarterly reporting season here in Australia with all of the AGMs. A lot of companies provided updates, and you can see in the fund returns, it's not just Catapult, but we've been getting some good news across the portfolio. And Experience Co, we're not seeing it in the share price yet, but a pretty good trading update from it at the AGM. It had announced a strategic review of the business, which was code for they put it up for sale. They didn't get the price that they wanted, and have said they're going to focus on improving things first. And there's some pretty good evidence for that starting to happen. Some good results for the first 4 months of the year. And international travel, it's been slow to recover, but the recovery is continuing month after month after month. And with some better weather here in Australia, I think it should be a pretty good trading period for it of late. Motorcycle Holdings, we've seen some pretty significant share price appreciation there. That company's been doing very well relative to a very weak market, and more recently there's been signs of that market recovering. The last quarter of 2024 actually saw growth in motorcycle sales here in Australia, and if they get a few tailwinds, it was cheap without them, but if they get a few tailwinds, that stock can do very well for us. And people in. Similarly, this is a labor hire and recruitment company that has been struggling in a very difficult market, particularly the placement side of the business. It's gone from contributing half the company's profit to almost nothing. But you're left here with a labor hire business that is much more stable and cash generative, and they've been able to repay a bit of debt recently, and the profitability of the company seems to be holding up okay. It's one that we think we can upsize if it can navigate this difficult environment. There's a bit of debt on the balance sheet, and we'd like to see it delever a bit. Down the bottom left, Aroa Biosurgery. We'll write more about this company at some point. It's a very interesting business. If you have a weak stomach, I'd advise you not to look at the company's presentations. It's in the wound care business, and there's some pretty horrific stuff. And its own product comes from the lining of sheep stomachs. Started over in New Zealand. They have quite a profitable, well-established product that is distributed in the US. The profitability of that is being clouded by a new product that they're developing that is currently taking up a lot of R&D. We think that picture is going to become a lot clearer over the next couple of years. Big Tin Can, we had proposed a board restructure at that company's AGM, which did not get the requisite shareholder approval, but the board has turned around and now recommended a 22-cent cash offer from a private equity company, Vector. If people remember, a quick reminder here, the board was proposing to shareholders a all-scrip bid from a US SPAC, which would have meant we ended up owning the same company but listed in the US, which the shareholders were very, very unimpressed with. We'll be glad to see the back of this one, and hopefully that deal goes through and we get the cash proceeds in March or April of this year. And then finally, another very successful investment for the fund, but we have sold the last of our stock in Gentrack. Share price is now up sixfold from our first purchase 3 or 4 years ago. The business is doing wonderfully well and continues to grow. Had a great results announcement recently, but that is fairly fully reflected in the share price and better value elsewhere for us on the ASX at the moment. Okay, with that, we will move on to Q&A. You can see the box on your screen there. If you just type your questions in, we'll just take a moment to gather a few of those, and then we'll be back for some Q&A. Okay, you ready to go, Bella?
Can you give me one first?
As good as you're going to be? No, I'll kick off with the first one.
Okay.
It's a good question from Matt Carrigan. We've had a big weighting in the Aussie portfolio in RUL for a long time. He says you've dropped it to 2.1. Is that an indication that you think further growth is limited, or merely that price has gotten ahead of value? It's a little bit of both of those. We thought that was a pretty weak full year result from RPM Global. It is not growing the software side of the business as rapidly as we hoped. Now, it can be lumpy and it may get better, but that growth is somewhat linear rather than the exponential that we were hoping for. The price has gone up a long way. And I think really importantly, the total revenue of this business has got that really high quality subscription software revenue in it. It's also got a consulting business where the margins are lower and it's going to be more cyclical. It's trading at a pretty healthy multiple of the combinations of those two amounts of revenue. So we think there's enough risk there and enough in the current price to reduce that weighting quite substantially. He's asked a question about Intelligent Investor review of Catapult. I haven't read that. I'm sorry, Matt, so I can't comment on that one. Another question on Catapult that I'll take quickly. You previously said the revenue per team is very low today. What do they need to do to increase that? Is it selling other products, increase prices, improve the value of the data? Look, I think all three of those things, I think there is just a lot of untapped pricing power there. Their focus at the moment is get as many customers as they possibly can and don't worry too much about pricing. I think that is absolutely the right strategy. They currently have 4,000 teams. They estimate the market at 20,000 teams. That 20,000 is also growing per year. So, they're delivering really nice incremental profitability at the current pricing. But I think as that business matures and they turn their strategy more towards increase in prices, there will be a further long runway to go. Bella, maybe you can take this one. What importance do you place on company borrowings needing refinance at today's high interest rates? Could it become a tipping point for a market downturn? Near zero interest rate borrowings requiring refinancing at higher rates.
Yeah, good question. It's obviously something that we give a lot of thought to, but in both funds, we're typically wanting to own businesses that don't have too much leverage, and we're typically wanting to own profitable, cash-generating businesses with manageable levels of debt. And an example, one example where refinancing isn't always bad is we actually had a company in the International Fund, Shift4. It's another payments processing company where they actually refinanced two convertible debts due to convert at the end of next year onto higher rates off of near zero. These are now at, I think, 6.5%, just below 7% rates. And although that is a lot higher, it actually helped clear a bit of a what they call a debt cliff overhang on these stocks. So it's actually been quite well received by the market. And I mean, on the flip side, we actually have quite a few companies in the portfolio that are positively exposed to rates staying higher for longer. One of those examples is Wise that I talked about earlier. And then we've also got Lloyd's over in the UK as well. So
Yeah, I'd say across both portfolios, there's certainly anyone that needs to refinance, I'd say is currently paying market rates. So there's not a lot of refinance risk there. And we're probably net positively exposed, I'd say, to interest rates staying higher, but it's not particularly significant across both of the portfolios. Dan says the cash weighting in the Aussie portfolio the highest it's been for a while. What's the Ideas Bank like in this current market? Look, Dan, there's a couple of things. We've got a really healthy list of new ideas that are under research at the moment, and there's also a really healthy list of stocks that we own pretty small weightings in that. If we get confirming evidence for our thesis, we would really like to upweight them quite significantly. That cash weighting's been bouncing around quite a bit as well. We are adding new ideas to the portfolio. We are taking money off the table on an RPM Global. So I wouldn't put too much focus on that snapshot at that point in time. And the other thing is we are still keeping a pretty careful eye on the redemptions now that the fund is unlisted and now that fee, the redemption fee window has closed as well. It has been better than I had probably expected, I would say. It's been really encouraging, but I think we do just need to carefully watch that over the next 6 months as well and make sure that we've got plenty of liquidity in the portfolio. And I'd say the average has been more than 10% for most of the past year. I think this process of having some cash and some, we own Dalrymple Bay Coal Terminal. There's some better quality, larger businesses in the portfolio, and the stuff that's done really well for us at the small cap end of the market. It's working really well for us. The portfolio liquidity is healthy, and I would like to keep it that way. I think the big end of the market is harder at the moment in terms of valuation, so that might result in more cash than would otherwise be the case.
I might jump in just on the international side as well, because you might have seen in our report, we're also holding slightly higher cash levels at around 6.5%. And this is almost double what we had back in October. And obviously we're not holding that cash just for the sake of holding it, but similar to the Aussie fund, I think we're holding that so that if we get the opportunity to redeploy, if we get a couple of our watch list stocks at better valuations, better prices, yeah, we definitely want to be ready for that, hence the high cash weighting.
Couple of quick ones. John says, does Forager still have a position in Madison Square Garden? The answer to that is no. Pete wants to know what price on that chart we entered TKO at, Bella.
Our average price is probably 120 on TKO.
Another one for you to follow up on. Any insights so far on the Japanese investments and the opportunities available in that market for Forager in general?
Yeah, we still really like Japan as a investment playground. We are happy with the performance of our stocks so far, and we're actually doing more screens to find a few new ideas to maybe recycle some that have done really well. I mean, one of those is Shift, and that share price is now up 75-80% from where we bought into that one. So yeah, definitely still excited about the space and screening for more new ideas in Japan. So definitely still perspective.
Dave says regarding Big Tin Can, is the ongoing spill vote resulting from the AGM now irrelevant given the vector bid? Look, I'd like to see a full scheme document out and the meeting called to vote on that, and that process well underway by the time they will still have to have the spill vote meeting. The question is whether the shareholders vote in favour of the remaining directors staying on board, and that will be contingent on this bid being very, very well progressed and almost impossible for anyone to get out of by that point in time. Bunch of Aussie fund stocks in questions in here. I'm just trying to. Couple of admin questions as well, which I might deal with at the end. Alan's got a question about whether Forager believes it has the expertise to understand emerging and developing investment areas such as AI, humanoid robots, cryptocurrencies, data storage, power needs, biosciences, space exploration, as well as the traditional old-style investment areas. Do you want to make a quick comment there, Bella? Or?
I'll make a quick comment. Yeah, we definitely think we have some expertise. I think the way we're trying to play it is more exposure to those areas. We hold a number of stocks that are exposed in different ways, and we also have a number on our watch list. Obviously, valuation wise, these aren't the cheapest stocks, they're all the craze, so there's a lot of momentum in the space, but there's definitely some really great businesses that we have on our watch list. So if we get the right price, you should expect to see them. I mean, the one thing I'll call out though is biosciences is probably not our area of expertise or where we're going to be fishing, so that's probably the one comment I'll make there.
Apart from sheep stomach wound care.
Well, yeah, I'll leave that to you on the Aussie side.
No, on a serious note, Alan, we like established businesses where we have confidence around the cash generation capacity of that business, and preferably some good consistent operating history to prove that. If we can get that with a nice thematic behind it, you've seen us have some good successes over the years with businesses that are in the right space. You've heard us talking today about live sports and the long-term growth that we think that sector can generate. It's fantastic if we can get it, but we want to own businesses that we can understand and where we've got an established track record. And if anything, a lot of the things that you've named there, I would say, are in the extreme hype category at the moment, and we can identify businesses that we think are going to benefit from some of those themes, but we're probably going to wait until the hype completely evaporates from them, like it has with an Aroa Biosurgery that was a bit of a darling stock and is now trading at a fraction of the price that it was. I might just take a couple of these Aussie fund questions here. This question about Megaport, we haven't ever owned that stock, so it must be confusing us with someone else there. I'm a bit of a skeptic about the intangible value in that business, so giving that one a pretty wide berth. Are you still holding companies in the gambling space? Yes, we own Flutter in the International Fund. We have a smaller number of shares, but still own PointsBet in the Australian Fund as well. Are you still interested in the non-banks? Yes. Couple of quite prospective smaller companies there, Plenty in particular. It's going quite well, and it's getting pretty close to past the emergency ward in terms of balance sheet and things. completely contingent on the credit environment here in Australia, but they've navigated so far quite well. You see any growth in mining services businesses given the current downturn in mining shares? I've been a bit surprised how healthy the prices of our mining services companies have been. Perenti up quite substantially over the past few months, and Macmahon's been a good winner for us over the past 18 months. They didn't participate in the mining rally, so maybe it's not that surprising, but those companies are performing well and growing, and there's finally a bit of market attention coming into them. We've reduced the weighting quite substantially on Macmahon, and we'll do the same on Perenti. They're the definition of, I guess, limited companies in terms of how much they grow, and even if they do grow, how much capital they're going to require to do that. They're not in the same stratosphere as some of our software investments. So they're the type of companies we want to buy cheap and sell less cheap, but still just recognize that, if you get 10 times earnings, you're doing well out of some of those businesses. Here's one for you, Bella. Jock says, is the weak dollar a recent tailwind? How do you protect or position yourself for an eventual strengthening? Do you want to take the tailwind piece, and maybe I can deal with the second half of that?
Yeah, I mean, I mentioned it before, but that weakening Aussie dollar has been a tailwind, and it's just hit a 2-year low, which has been a benefit to both fund and index returns over the last year. I'll leave you to answer the bit about protection in the strengthening situation.
We have not historically, and I don't think we're going to change this, really tried to do anything. Predicting currencies is something of a futile business, and I think one of the benefits that our product provides to our clients' portfolio is that international currency diversification. Sometimes that's going to work for you, sometimes it's going to work against you, but it's not really our job to be gambling on that, and it's typically been very correlated with stock market performance, maybe less so over the past 6 months, but in heavy crises, you normally see the Aussie dollar pretty weak. So it has been something that has provided for lower volatility than otherwise. And I think generally there might be little bits that we do about the edges, but you should expect it to remain unhedged for the long term. Bella, Chris wants to know whether Steve's knowledge of cricket is on par with his ability to pick stocks, or is there nothing he can teach you about cricket? You need to be very careful how you answer this.
I am only just getting back into cricket, so you can probably teach me a lot more than I know right now. And he's done all right at picking stocks, so I
You can
think
say there's nothing he can teach me about either. There's a few more here that we might get back to on time. There's maybe a question here. What's compelling about the Aroa biosurgery business model that entices you to buy it? I think I touched on this in the presentation, but there is a very well-established business here that is growing very nicely. It's actually distributed by a NASDAQ listed US company, so we get their results quarterly. It is a better product than both human skin products that people sometimes use, which is a very significant operation for people. And then there's completely synthetic products as well out there. And this is in between those two things. It's much cheaper and almost as effective as the human graft type products. So the product itself is profitable and growing very well and has quite a nice history. It's being covered up by the new product. We don't really have a strong view about whether the new product's going to be worth a lot of money, no money, or slightly negative. But at the moment, we think you can buy the whole business for a discount to what the established product is worth. So something goes right with a new product, that's great. If it doesn't and they stop spending the money on the development, then it's still going to be a cheap stock. All right, I think that'll. I'll touch on a couple of these admin questions quickly. I can get back to you with more detail if you want, Ross. But Ross wants to know about the timing of buying and selling units, and we've had another question about the distributions as well. So this is the way it works. You need to get applications or redemptions in before midday. It's daily price, so any day. You will get proceeds for, or you'll get issued units at the price that is calculated at the end of that day's trading. So for the Aussie market, that's when the market shuts at 4. For the international fund, it's not until the US market, which is the last to close, closes 8 a.m. the next morning. We then, or the administrator then, needs to do a unit price calculation that usually happens by lunchtime or a bit after the following day. They send that to us for approval. We send it back to them and say, yes, it's right. So it's afternoon the next day by the time that unit price has actually been calculated. And then it's another 24 hours minimum before that gets processed. It might be a little bit slow at the moment. There's some complications around distributions. You need to calculate a unit price after the distribution's been paid. But we aim to have it out 5 working days at the most, and it's usually only a couple for that to happen. So we do try and keep that pretty tight. And question about distributions, it will be paid, my understanding is the 14th of January in terms of actual cash turning up in people's bank accounts. But obviously the unit price at the moment for both funds is already ex-distribution. One last one here from John Simon. Have you participated in any recent IPOs? And the answer to that is yes. There's actually a stock in the Aussie fund, Cuscal, which we don't do a lot of IPOs. They're usually priced for perfection, but this one is an interesting one because of the shareholding structure prior to IPO. It's a bunch of banks that are maybe less price sensitive than, for example, a private equity firm would be, and a really interesting piece of infrastructure in the payments space here in Australia, and less market sensitive than some of the other payment stuff that we own. They get paid basically per transaction. So as long as people keep using cards and phones more than they're using cash, this business should grow at some pretty modest rates, but it's nicely profitable. It's a low earnings multiple, and a business that we've actually got a decent, I think it's almost 3% of the portfolio, so a decently large, for now, investment in it. Don't expect us to do a lot of IPOs, but the window, because it's been such a bad environment for IPOs, you're actually getting better prices on some of this stuff than you would in a more bullish market. Okay, if I haven't got back to you and we do have your name, then we will answer your question on email. Thank you very much for tuning in, everyone. It's been a great turnout today, and thank you, Bella, for your first webinar. Appreciate it.
Thanks for having me.
Thanks, everyone.